Welcome to our podcast where we talk about real financial problems with real people and really come up with real financial solutions. My name is Irene Meyer.
And I'm Philip Villanueva. So let me ask you a question. Okay, so let's say you are wanting to buy a home. Why do people want to buy a home? A house?
They feel that they own something.
Okay. And right now I'm seeing there's a big push in social media right now about real estate investing, right? And things of that nature. People want to buy a home because they like ownership. So they have ownership of something. But what's the point of having that ownership?
What's the point of ownership? I guess just, again, it's about people feeling like they are wealthy. Is that what you're asking?
Well, no, I'm wondering if in regards to buying a home, if it's the ownership, it's just the fact that you just want to say I own a home. Is it a status thing, or
Oh,
are you
yeah.
saying it's a status thing?
Yeah.
Okay.
What do you think?
Ever since I was younger, the only reason why I've ever thought about, or anyone that I've ever talked to, they were just thinking about it for literally like it's something tangible that they own that's appreciating as an investment. They always talk about it as an investment, right? So
Yeah.
it's something of value as opposed to
Right.
status. That's the way I've always thought about it. That's the way a lot of the people that I've talked to have talked about it. I haven't come across too many myself that buy a home just because they want to have a home, right? Like they want to own a home. It's always for the reason of value. Does that make sense?
Yeah,
Or
no, I've probably come across both, but more or less when people start thinking about buying a house, saving up for a house, getting a mortgage for a house, no one
mm,
talks about that part, the benefit of owning a house that way.
okay. Most of the people trying to get a mortgage, what's the average age?
Oh, it's interesting you asked that because I have a young guy who's just entered into an agreement to buy a house.
Yeah. And that would make sense to me because then, if you start thinking about it, at least then, you've got the time to build the capital and do all of that because there's a lot of costs in buying a home, correct? I was looking it up for today's, you need what, 5% down? At least 5%. So if it was like a $500,000 home, which is a typical home nowadays, right? $500,000, you're looking at like having at least 25,000 for the down payment. But then the closing fees are about 4% of the cost of the home. So that's another 20
Right,
grand, right?
right.
That's something that they never talk about up front. I found that interesting because I know a couple of people who've looked at buying homes somewhat recent, and that was never brought up to them in the beginning. The biggest concern was getting the 5%,
Yeah.
right? But then, okay, you do all this footwork and they hit you with a 4% after the fact. Right? Wait a second. And then is it fair to say general upkeep for a home is probably 1% of the overall cost annually? Like upkeep.
Oh, yeah.
Okay. So if we calculate like on a $500,000 home, you're looking at about 4 grand a year just for upkeeping that home annually. Makes sense,
Yeah.
right? And then an average mortgage for a $500,000 home is probably around 2,500 bucks at a 5%, at a 4% mortgage rate. And that 4% right
Yeah.
now is pretty conservative, I would say.
Yeah.
I was looking at them and it can range anywhere from 3.8 to 5, whatever mortgage rates. And so I went in the middle and said 4. Okay, so just working with those numbers alone, if you waited and you didn't do anything and you're a renter and you're now hitting your late 30s, 40s, 50s, you're probably not going to make sense.
Like a new home, you mean? Like, or
Yeah.
buying your first home?
Your first home, you're a renter and you've
Yeah.
always wanted to buy a home, but you haven't done the right steps to get there. And you're now in your 30s, late 30s to and above, and you come across a financial advisor and you talk to that financial and say, hey, listen, is it possible to buy a home? Unless you come across a lot of money or you have a lot of money to start trying to build something, which if you're a renter, you probably don't, like just to be honest, because there's so many other expenses. You're probably never going to own a home. Does that make sense? Okay.
Yeah. Well, and it also depends on where you live in
Yeah,
Canada.
yeah, fair enough. Some people will move to depending on where Sarnia, where I am, it's typically not that expensive, but it is now. But it typically
Mhm.
wasn't that expensive. A lot of people were moving here just because they could buy a home, right?
Right.
Okay, so I don't know about that either. Like you're uplifting yourself, you're changing your roots, you're changing your environment,
That's,
so you can
yeah, there's
say,
more
I have a
cost.
home,
Yeah,
right? Now, I understand the purpose of that is 100% investing at that point because you're wanting to turn that home over and then maybe relocate to where you want to actually be once you turn it over. Does that make
right.
sense?
Yeah.
That's what I would think with those kind of people. Here's the thing though, people who are real estate investing, they're having to get a mortgage to buy that home. So they have to clear that mortgage before they make any profits on that home. So there's a lot of variables there that people usually when someone says, I want to start real estate investing, they don't consider these variables at all. Yeah. Okay. So you're that young 20-year-old, you have nowhere near $55,000 to put down because you don't have the closing and you don't have the 5%. And you might not have the greatest credit, right? You may not have the greatest credit for an approval. You have the money, you have the 55,000, you have enough for the mortgage. You just have sketchy credit.
Or you have a lot of debt still.
Yeah, or you might have a lot of debt, fair enough, right? But you're still renting, you still have an outgoing expense, you still have to survive, you still have to provide a home, right? So you have debt, you have maybe not the greatest credit, you might have not have a credit score that can be approved without a cosigner, right? And they cosign you because you're in debt and you don't have good credit, so they don't want to cosign on you. And so you're not able to get a home and you really want to have ownership of something. Okay.
Right.
Now we've talked about this, and you said this once before. You don't believe in running before walking and crawling before you stand up when it comes to insurance and using insurance
Right.
as an investment tool solely. You're right. Yes, that's right. You did say solely. So, what I would like to talk about today is that particular situation, right? Where you can actually use insurance. There are many kinds of insurance, and this is what a lot of the general public is not aware of. There are so many different kinds of insurances out there, right? I'm going to target two specific kinds: permanent and term. Term insurance being one that's just like a renter. You're going to have a certain amount of insurance coverage in case you die. Your beneficiaries, it's a death coverage. Whoever is left over is going to have a lump sum of money given to them. And so be it you've covered your loved ones. If you happen to survive for the length of that term insurance, then thank you for your money, but you no longer have coverage unless you renew. And when you renew, it's going to be considerably more because now you're older, right? And who knows what your health is like at this point. We don't even know if
Right.
you're going to be insurable at that point. Then there's the cash value style. And this is what a lot of people don't know about or have seen way too much on social media that it's been construed in so many different ways, right? But the cash value is one that actually has what's called an accumulation fund, or an amount of money that's invested. We'll use the term invested, building inside of the insurance policy. Right now, they are not. Let's say you were to pass away; they're not both given out. Only like it's the death benefit. So you have to take advantage of the cash value, or you're taking advantage of the death benefit. You can take advantage of both if you do it right. But if you were to pass away, only it's a pure death benefit at that point. Correct? Okay. Now, let's say you're that young 20-year-old. You said how old roughly is your client?
Like beginning early 20s.
Early 20s. So let's say he's a 25, 24, 25 year
Sure.
old, right? And he's in this situation where he's got all the money, got everything. The ducks are all in line except for debt issues. So the debt to credit ratio doesn't balance out, and his credit score is not at par to what the mortgage companies want. Okay, fair enough. So let's say we revert this to an insurance policy and we let them know the idea of, instead of owning a home, keep renting, right? No problem. You have a home, you have your rent, but take the money now and let's put that into an insurance policy. So then by the time you're done, let's say you did a 25-year mortgage, you would have the same value of ownership as if you were to buy that home, right? If you wanted to cash out your insurance policy at that point, you'd have more than enough to buy a house outright. And here's the thing is, I'm going to give an example of this. So this is a PDF, and what I've done here, okay, I've set up a $500,000 insurance policy, value of a $500,000 home. Okay. This insurance policy for the age of the person was
20.
25 years old. Okay, so we're dealing with a 25-year-old. Okay, so it's a 25-year-old, and they're doing a $500,000. The cost of this, if it's a male who's healthy and doesn't smoke or anything of that nature, was like 280 some odd dollars. But instead, what I did was I set this up to be a $400 monthly contribution instead. Okay, because he would be paying, $2,500 a month anyway for a $500,000 home, right? So instead, $400 a month going into an insurance policy. So he's got this, okay? And you can see here how, and here's another thing, when you're buying a home, people think, oh, as soon as I buy a home, it's now a profitable asset. It is not, right? Just like an insurance, see here how it says surrender value there? That surrender value is growing. And then by year 15, it's worth $114,000. So if you were to say, okay, at year 15, I no longer want to have this policy, you can cash it out. You can sell it just like you would sell a home, but you're selling it back to the insurance company for $114,000. Same idea as a home. You don't want your home anymore. You sell your home. They're going to give you whatever the value is of that home at that time. It could take up to 5 years before a home starts to appreciate in value. Yep. And that's with the assumption that you've paid off your mortgage. Because if you haven't paid off your mortgage, you don't own that home. The bank still owns that home.
No.
Right? And that mortgage is going to come off of whatever you sell, the selling price of that home. So here, there is no mortgage. Other than your contributions on a monthly basis, this cash value, the surrender value, is 100% yours. Sell it.
To take on this policy.
Sorry?
Because you haven't borrowed to take on this policy. Right.
No, you haven't borrowed any money to take it on. The only thing you have to be is healthy. That's the only prerequisite. They don't even want to do a credit check. Right? So at this point, you're putting $400 a month in, okay? And then by the time, like a lot of people, they say the home that they buy is going to be their retirement home. So if this is going to be a retirement home, by the time you're 65, this insurance policy is worth $840,000 to you. You cash it out, they're going to give you $840,000. There you go. Okay, that's a nice little retirement package. Okay, now this can be manipulated to pay it off in 25 years or whatever. This particular one was set up. You stop paying after a mortgage, 25 years. You stop paying into this one. So once you stop paying into this one, it's now worth $323,000. You're no longer paying into, you're no longer contributing, but it's growing still. The value of this policy is still growing. And you can see either at 63, if you want to sell it, you're now at age 50 and you want to sell it, you got $300,000 down payment on a new house, have at her. So you could do that, or you could borrow against it. There's other things you can do against this, but we're just talking about the immediate liquid cash, right?
Right.
You sell the insurance policy back, you get $300,000 up to $840,000 at age 65. Okay. Now on the flip side, you still have $55,000 sitting there, so you still have $55,000 sitting there, and you still have $4,000 of annual upkeep of a home if you were to have that, those expected expenses. Right. So what are you gonna do with that? Like, just spend it? You could blow it, or what you could do is invest it. Are you seeing the same? You could take that $55,000, put it all into a TFSA if you've got the room, and a 25-year-old probably would, right? Because if he hasn't done anything since 2009, he probably would have room for $55,000. So dump it into a TFSA and put $4,000 down every year for 25 years. And you can see, not only after 25 years would he have his $323,000, he would also be a millionaire. I don't think buying a home at that point would be an issue.
I don't think so either.
Yeah. So this is the thing is, now this is definitely, let's say to 99% chance, going to happen if he doesn't manipulate the process. meaning he doesn't dip into his TFSA, take money out here. The minute you say, oh, I'm just going to take some money out and I'll put some money back in later, you've manipulated the process. Or if you say on the insurance policy, can I just reduce my payments this month on my insurance so that and then I'll make it up later? You've manipulated. If you don't do anything with your process, then you're looking at a 99% chance that this is going to happen in year 25, where you would have 1,300,000 and roughly $50,000 with the insurance policy as well. Okay.
Right.
So you're a millionaire, right? At that point.
By the time you're 50.
Sorry?
By the time you're 50.
By the time you're 50. One, there's not a lot of 50-year-old millionaires out there. Is there a guarantee that $500,000 home would be worth $1 million in 25 years?
No guarantee.
No guarantee. And it may not be, right?
Just like someone can fight the argument or have the argument that stock market is like that too.
Absolutely. But here's the thing is, again, I'm going with a conservative 10%. Right? I'm not trying to say you're going to get 18, 20%, all these things. Right now, the markets are down. My markets are down. They went down, crazy hit. They went from 28% down to 24%. But there's some people that are in the negatives right now, depending on how their investor has invested their money. So here's the thing. And while I was thinking about this, I'm thinking there's a lot of people who want to buy a home because they want to somehow figure out a means of investing into themselves. Okay. But they can't get there. They're young. They're not paying so much attention to their credit scores. They're not paying so much attention to how they're spending their money. But then they come with that realization. But by the time they can put everything to effect and get started, they're going to be in their late 30s or anything before they can get started. And by that point, they've probably dipped into that down payment that they've got and the closing fees that they've got. They probably dipped into those funds. And it's just a vicious circle that they're going through. Okay. So they're in this vicious cycle and circle that they don't know if they'll ever end up getting a home, and they usually end up just being renters, right? They've always had the dream of buying a home, and then they're going to be in their 40s or 50s thinking, it would have been nice to have bought a home, right? And for the reason of, because they're thinking about their retirement and they won't have anything for their retirement, and it would have been nice to have a home because then they would have had some kind of investment that they could have sold for their retirement package. Here's another option that a lot of people, most people, don't even think about.
Right.
Right? They don't know about it. Second reason is it's just never been presented to them as an option, right? Yeah. They've seen maybe videos of it, but if you're not in the industry and you're seeing a video, it's talking a language you have no idea. It sounds like, oh, this is too good to be true. I'm missing something. Right? This is where they can contact you or me or an advisor of an insurance agent who deals in holistic, because again, we didn't just touch on insurance. We talked about taking some of that money and investing it. A holistic insurance agent who can do everything and look at what could we do? How long would this take for you to dig yourself out of this hole to actually be able to afford to get into a home? Plus calculating the inflation cost of the home, because let's say you're able to do it 10 years from now, 5 years from now. Are the homes going to be the same price as they are now? Likely not, right? So we have to calculate inflation into your game plan. By the time you're ready, will inflation have made you not ready again?
Yeah.
Right? Let's eliminate that then. Let's do this for now, because this is something that we can do right now. It's going to give you something of value, right? It's not going to be something that's based off of your credit. It's something that is based off of the hard work that you've done to get yourself to this point. You've worked hard to get that down payment. You've worked hard to get that closing fee. You've worked hard to be able to make sure that you can cover annual upkeep of a home. Whatever. Right. We can work on getting you out of that debt now. Plus building up, you're at the same time. Right?
Yeah. I think this is a great way of looking at insurance for sure. And I guess the caveat is, like you had mentioned, you do have to be healthy. So you still have to get qualified. No different than having to get qualified for a mortgage at the bank, but a different way of qualification. I think there's a very important thing here. As you were talking, this is not one of those things where, oh, I need to reduce my payments this month, or, oh, I need to take some money out of this. Can I do that? Because let's face it, if you went into a home and your mortgage was what it was, and things were in a month. You can't go to the bank and say, hi, I'd like to not pay this anymore. Can you reduce my payments? You can't do that. And you're not going to sell your home to take out cash, right? You can't do that. So you almost have to treat this opportunity that you can have right now and actually build equity right now without waiting to be able to get a house. You can build this equity like
Right.
the urgency of not, again, it would be unheard of for you to go to a bank and say, hey, can you reduce my mortgage payments because I just can't afford it right now. You can't
Mm.
do that.
People try.
And this is a great opportunity for you to build that habit and what we call adulting, where you start looking at your money in a different way of, like you said, Phil, why people buy homes in the first place, for building assets, building wealth. If you want to build assets and build wealth, you got to think of many different ways to do that. And this is a great way, a
Mm.
great illustration on how to do that, Phil. For the right person, it makes sense.
Yeah, absolutely. It's for the serious person who really wants to do something with their lives. A lot of people you hear, especially the young generation, I want to live for today. I want to enjoy my today. Tomorrow is later, right? It's gonna happen. It's later, but tomorrow is going to come.
Yeah.
That's the problem. Tomorrow is going to come, and it's going to come sooner than you realize. And if you haven't done your due diligence, by the time tomorrow gets here and you're not ready, it's too late. And
Yeah.
that's the problem. Like you hear, especially with the younger generation. And it's funny because I was watching a podcast, and these people every month get together with millionaires, and they'll do what they call a millionaire call, and millionaires call in. And the most common theme of people who are millionaires, and by the way, it's always talking about their retirement packages, which is their insurance policies, and their investments, their stocks, right? And their liquid assets, like their homes and things of this nature. That's all of it is encumbered to calculate their net worth. So when they talk about a millionaire, the value of their home, the value of everything is calculated in there as well. When these people are considered millionaires. And so when they were asking, the most common theme in all of them was one, the most important one, living below your means. Always living below your means. Don't they all of them, these are millionaires, and they talked about how they would buy their clothes at thrift stores. Like they own, or I've never come across one, but those high-end third-party stores where you can buy like $400 jeans for bucks or $30.
Yeah.
Those kind of
Consignment.
consignment stores, yeah, like a low high value consignment.
Yeah.
Yeah, so these people were that's where they say that they buy their stuff. The guy would ask, how the pants that you wear, how much do they cost you? And one lady said mine are like $4. She was worth she was $3.5 million. So what she was worth, her jeans were $4, she said. None of them were over splurging. The one guy was talking about his high-end car, right? He never said what it was, but he kept talking about his high-end car. And the guy finally said, okay, I gotta ask you what your car is. It was, oh, my Honda Accord. The guy near died. The guy started laughing so hard. That was his high-end car. And this guy was worth 4 point some odd million. And that's the kind of car he was buying. And it's so funny, interesting, like listening to these guys talk. And it was always the same thing. Live below your means. Don't be frugal, but invest today for who you want to be tomorrow.
Yeah.
Right? Because
I think this
tomorrow,
video is sorry, I just want to make sure that everyone understands when we're doing these videos. Phil did a great illustration on how a year-old can really do something now, right? If you have children, guys, or adult children, there might even still be at home, and you know that maybe your finances aren't quite what Phil showed you, but you have children that you could pass this video on to, or at least teach them that, yeah, okay, so what I was taught didn't work out, obviously. I'm still in a mortgage. I still have debts. But my kid who's 25, this is the kind of video you should be sharing with them, and being open-minded to the fact that there are other ways of building wealth. And maybe some of the talk track you're giving to your kids is, yeah, own a home, don't rent, stay here for as long as you can so that you can save your money. How often are you holding them accountable to doing that, saving their money, right? They do as they see what you do. So if you're not talking about things like this, or even reaching out to someone like Phil and myself about how to get this started for your kids, then your kids are going to end up being in the same position you're in, right? You're 50 and you have no $1 million, but your kid could. And to me, that's peace of mind that they would never have to rely on you ever again if they built these habits now. But it's a different way of looking at things. This is a video that might be too late for you, but you have people you know that you can pass this video on to.
And as a parent who's struggled and not been able to get to where they want to be, but have children, there's that feeling of guilt that I'm not going to be able to leave a legacy behind for my kids, that nature. You don't have to feel guilty about that, because if you leave them with the ability to do it themselves, you've left
Yeah.
them with a legacy. You don't have to actually leave them with the money or the wealth to not have to do anything. But if you leave them with the ability to get there themselves, you've left them with a better legacy, right?
100%.
One that they
Yeah.
can pass on, and they can pass on,
Right.
right, at that point.
Right.
And that knowledge, that's where the true wealth is. And
Yeah.
that's what people miss. They feel so guilty because oh, I can't leave $1 million inheritance for my kids. Yeah, you can. Give them the knowledge of becoming a millionaire.
And I think this is a great time to leave off because I think we can go on, but that was a really great illustration, Phil. I'm glad that you showed that to me. And I realized that I probably knew that deep down, but I think at the end of the day, it's just about realizing there are other ways to building wealth. And your question about why do people buy homes, just asking that question alone would probably open up your eyes to what you actually really want. Signing off from Keeping It Real.
Okay, have a great weekend.